Guys, during this banking crisis, have you noticed how well REITs are performing? Well, REITs and the commercial real estate in them are very closely tied to banks, obviously. And what you may not know is they are more tied to smaller banks than larger banks. And why is this a big issue? Because when these REITs have to roll over their loans at higher interest rates, they may not be able to cover the mortgage, especially because a lot of these buildings are not full because a lot of people are doing the work from home thing and don't want to come back to the office. And so that has the potential to blow up the already fragile, smaller, and regional banks. So let's take a look at how bad it really is. So, once again, Zero Hedge has a really detailed article on this, but it is from a Morgan Stanley research report. And so they say the commercial real estate market is 11 trillion in size with 4.5 trillion of debt outstanding. And so of those 4.5 trillion, banks have 38% share of the debt outstanding, followed by government sponsored entities, 21%, life insurers, 15%. And this could be why some of these life insurance stocks are also falling as the banks are having problems as well. Commercial mortgage-backed securities 14%, and REITs only 4%. And you see, small domestic banks have about $2 trillion dollars of those loans, while large banks have only about 847 billion. But as a percentage of total assets, that's about 29% of small domestic banks' assets versus only 7% of large banks. So while regional and local banks have only about 30% of their assets in commercial real estate loans, when you zoom into the worst segment of commercial real estate, the office segment, then regional local banks comprise about 62% of the loans to this segment versus 38% for the larger national banks. And if you look at the commercial real estate lending by group, the gray is the 2015 to 19 average. The dark blue is 2021. The light blue is 2022. And you see regional local banks have increased their lending from about 17% to about 30%, whereas the large national banks actually have decreased their lending slightly, as well as government agencies and even commercial mortgage-backed securities. So investor driven has increased. So what does this look like? Is this the dumb money is increasing at the time when commercial real estate is about to implode? So they say at the end of 2022, the amount outstanding of commercial mortgage loans in the US was 5.6 trillion, and half of this stock sits directly on commercial bank balance sheets, with small banks capturing a much larger share than large banks. So if you include mid-sized banks with small banks, meaning less than 250 billion in assets, we estimate that the combined share of small and mid-sized banks is 80% of the overall stock of commercial mortgage loans. So excluding securitized CMBS market, banks originated over 40% of commercial mortgage loans in the first half of 2022. So while large banks didn't increase their loans by much over the last 5 or 6 years, small banks have been increasing like crazy. Now, it's going to take a while from the point where the banks made the mortgage for the commercial real estate till the commercial real estate can't pay the mortgage, till they default, till they have to sell it off at a lower price, and the bank will have to mark the loan to the actual market. That's going to take a while. But if you want a real-time look at what these real estate loans are really worth, you can see in real time by looking at the stock of VNO, that's Vornado Realty Trust, a REIT. And it is an S&P 500 member and one of the largest REITs in the US with a New York City focus. So this is the market voting in real time what the value of those underlying real estate assets are in VNO. So what do you think those mortgages are worth on the books of those smaller banks? Well, maybe people will come back to the office, right? Well, according to this, Office utilization has shrunk by approximately 50% since the onset of COVID. Per Castle Systems, they are the ones that actually do the reading of the cards when you enter and exit a building, so they know exactly how many people are coming in and out. And the vacancy rate of office properties has grown from 9.5 to 13%. And so this pressured rents and leasing activities for office landlords. And so Green Street estimates that office appraisal values have fallen by 25% over the past year, with a 10% decline in February alone. Consequently, the aggregate level of leverage for office borrowers has grown, with offices composing 20% of total commercial real estate asset values, but 30% of total commercial mortgage debt. So they're taking on more leverage to buy these properties that are not being filled up. So they have much less wiggle room to weather the storm, and they also have less skin in the game. So if these things fall too much, they'll just walk away and send the keys back to the lenders, which a lot of companies have already been doing, including Blackstone and PIMCO. And so in the next 2 years, there is about $1.1 trillion in commercial mortgage maturities coming up that need to be refinanced at most likely a higher interest rate. And over 5 years, that number is about $2.5 trillion in maturities coming up. And so if you look at maturing loans by lender type in billions, this brown, it is banks mostly that bear the brunt of all of these maturing loans that are coming up. And so Goldman Sachs says we expect sharp increase in office delinquency rates in this cycle given the negative impact from higher interest rates. So delinquency rates peaked after the great financial crisis and have been coming down ever since from about 4% to less than 1%. But with the yield on the 10-year Treasury spiking up, it is likely that when these loans mature, they're going to have higher interest rates. And so obviously the delinquency rate, especially for offices, are also going to increase a lot. And so this chart of the commercial mortgage back index, BBB2, is down about 15% since the beginning of the year. So this is the reality the banks are going to have to face eventually when they have to mark to market their loans on their books. So with these small banks loaning the disproportionate amount to commercial real estate, they are hugely exposed, especially when they start having to mark these loans to reality instead of the theoretical money that they loaned on them. It's not going to happen all at once, but I'm sure the Fed realizes this and they see this as a huge problem coming down the pike. So guys, realize that all is not well in the economy, no matter what the lying talking heads on TV tell you. Prepare accordingly.